So let's dive into something you don't see every day in the world of finance. We're going to unpack a real head-scratcher. An analyst takes a hard look at CIBC, one of Canada's biggest banks, likes what they see, and then turns around and tells investors the stock is just too expensive. How on earth does that work? Well, let's figure it out together.
Right, this is the core of the paradox we're tackling today. It just feels like it defies logic, doesn't it? An expert says, hey, this company is actually worth more than I thought, and bumps up their valuation by a huge margin. But then, in the same breath, they warn you, but don't buy the stock, it's overvalued. It sounds crazy, but there's a method to the madness. Let's break it down.
Okay, so this image right here puts the problem in black and white. You can see the market price. What people are paying for CBC stock right now is over $128. But then you see the analyst's fair value estimate, and that's way down at $100. That huge gap, that's everything. It's the difference between market hype and what the analyst thinks the company is fundamentally worth. And that gap is exactly what we need to understand. All right, to solve this little puzzle, let's start with the good stuff. Why did the analyst even upgrade their valuation to begin with? What great news did they see that made them more optimistic about the bank's value? And here it is, straight from the horse's mouth. This is the exact quote from the Morningstar report. The analyst, Mo-Yuen Chen, puts it right out there. We're increasing our fair value estimate to CAD 100 from CAD 83. I mean, that's a massive jump, nearly 20%. But then comes the whiplash in the very same sentence. We still view the shares as overvalued. So let's start peeling back the layers on this.
Now, to really get this, you have to do something crucial. You have to separate the company's performance from its stock price. They are not the same thing. So let's start with the bull case, the good news, that explains why that valuation got such a big boost.
And the reason for that upgrade is pretty simple, actually. CIBC had an absolutely phenomenal year. The real engine behind all of this was its capital markets division. You know, the part of the bank that handles all the big-time investment banking and trading. And their performance wasn't just good, it was off the charts exceptional.
And this chart just shows you the incredible scale of what we're talking about. Just look at the trading income alone. Back in 2022, it was sitting around $1.2 billion. Fast forward to 2025, and it had absolutely exploded to over $4 billion. That's more than a threefold increase. When you see a surge like that, there's no way an analyst can ignore it, and that right there is the main reason for that higher valuation.
But here's the pivot. Here's where the story takes a turn. Because one amazing year, well, that doesn't guarantee an amazing future. And this brings us to the bear case, the reasons for caution, and why the analyst is basically waving a giant red flag despite these fantastic results.
The key word here is sustainability. See, the analyst believes that this incredible 2025 performance was an outlier. They're saying it's way better than what you can expect in a normal average year. They're actually forecasting a cool down, projecting trading income will drop by 20% and advisory income by 15% next year. So in their eyes, 2025 was a spectacular peak, not some new, sustainable normal. And it's not just about a short-term pullback. The report points to two bigger, longer-term worries. First, out of all the big Canadian banks, CIBC has the most exposure to the Canadian housing market. That makes it a bit more vulnerable if that market ever takes a serious downturn. And second, the bank is pushing hard to expand in the U.S., a market that the report notes is just less profitable, which could actually drag down the bank's overall returns over time.
Now, to put all these risks into the right context, we have to talk about the bank's fundamental strength, or what investors call its economic moat.
It's a pretty simple but powerful idea. Think of a castle. A wide, deep moat protects it from attackers, right? Well, in business, an economic moat is the same thing. It's a company's built-in advantages, things like a powerful brand, or the fact that it's just a huge pain for customers to switch to a competitor. These things protect a company's profits, and the wider the moat, the safer those long-term profits are. So how strong is CIBC's moat? Well, this report gives it a narrow rating. Now, what does that mean? It means the bank definitely has some real durable advantages, but they're just not as dominant as some of its biggest competitors like Royal Bank or TD, who get a wide moat rating. And this chart really breaks down why the moat is considered narrow. You can see that about 65% of CIBC's business is its core Canadian banking operation, which is very well protected and moaty. But that growing slice of U.S. operations, about 20% of the pie, is seen as not moaty. So that expansion into a tougher, more competitive market is what kind of waters down the overall strength of its moat.
Okay, so let's pull all this together. On one hand, you've got a company that just had a blowout, record-breaking year. But on the other hand, you've got some real future risks and a competitive position that's good but not great. So let's get to the final verdict.
This table adds some really important context. Yeah, CIBC stock is trading at 1.28 times its fair value, or 28% higher than the analyst thinks it's worth. But then look at its rivals. Royal Bank and TD Bank, the ones with the stronger, wide moats, they're trading at an even bigger premium. This tells us it might not just be a CIBC story. The whole Canadian banking sector might be priced for perfection by the market right now. So here it is, the key takeaway. The analyst is essentially saying the market is making a classic mistake. It's looking at that incredible, record-smashing performance in 2025 and assuming that's just the new normal. The analyst is arguing that's a mistake. It was a temporary peak, and the market has priced the stock for a level of perfection that probably can't last.
And that brings us all the way back to this one number, $100. This isn't just a random price target, it's a statement. It represents the value of CIBC based on its sustainable, long-term fundamentals. What's left after you strip away the temporary high from one incredible but likely unrepeatable year?
So at the end of the day, the report is saying that CIBC is a solid bank. It's got a real foundation and real competitive strengths. But it leaves us with this one big question. Even for a good company, is the price of admission just too high right now? Is the market paying for a best-case scenario that may never happen again? And that's the paradox at the heart of this very confusing, overvalued upgrade.